Hello, everybody. Welcome to Tuesday. The S&P 500 was down a little bit more than 1.4% today. And really, we kind of have this very interesting battle going on in the market right now. You have one group that feels like the economy is stronger than expected, looking at the jobs report, looking at the growth in wages, looking at, how strong the service economy has been, reports that we've gotten over the last few days. And they feel like the Federal Reserve is going to be raising rates more than expected and holding them up longer in order to finally bring down inflation. And that brings on the possibility of a higher recession. You get another group in the bond market who actually doesn't believe that's true. If you look at the action today, the yield on the 2-year Treasury was down. If the bond market felt like they were going to be raising rates higher, the bond market would have been up. And the Fed funds futures rate was actually down today, which just means that the projection right now is that the terminal rate, which is supposed to be around 5%, would be actually lower, dropped to 4.9% today. And it's kind of interesting because there's a lot of people thinking that it might be closer to 6% in the terminal rate. And they might be right, but the bond market is actually saying that rates might be lower here in the future. And so you've got this kind of complex scenario where people are selling off. The bond market is saying something else. The bond market has been more accurate about these things, especially economically sensitive areas like this, than the stock market has in the past. So we kind of have to lean that way. But at the same time, when you look at what's happening in the bond market, it is probably signaling that the rates might be lower in the future. And that's a possible reason, is that we have a recession that happens maybe sooner than later as far as that goes. So that's what we're kind of all looking at here, is what happens. Now, looking at recession for next year, the weird part about it is the economy is actually pretty good. Consumer spending is doing pretty well. We've got a situation where, the job market is good. Wages grew twice as much as expected. The service economy is stronger than expected. And so how do you have a recession in that environment? So it seems like that scenario with a fairly strong core piece of the economy moving forward might help to support earnings more than expected. And so this is going to be a really interesting earnings season that's coming up in the first quarter of next year. And because in theory, you could have some better than expected earnings because of the strength in the economy. But then a lot of the different CEOs and CFOs start talking about forward guidance and seeing things that might be negative going forward, and the market has a potential sell-off from that. So at the same time, these portion of the economy that keeps doing well, even though it's not supposed to be, always surprising the market itself. Maybe it keeps going. I think the one thing that's really being discounted here, and nobody's talking about, is the pent-up demand that happens as people are coming out of this pandemic. People are spending money, even credit card money if they have to. Maybe not a wise thing to do, but they're supporting business essentially by getting out there. We're all locked up for such a long period of time. And I don't know that the methodology that people are using to looking at what might happen to earnings and what might happen to this type of economy is the same as what you would have looked at in the past, because we're coming out of a pandemic, which creates this situation where people are really going to go out and do things. It's a period of time that there were people that would have gone and done things regardless of what was going on with the pandemic because of their own beliefs, but you couldn't do anything. You couldn't go on a cruise. You couldn't go on an airplane. You couldn't go to restaurants. You couldn't go to the gym. They were all closed. So that group got out there right away as those things started to, reopen. But now you have another group that is much more cautious, that is continuing to start to come out, and more people are starting to come out and starting to do all of those things. That's a lot of money being spent. There's a lot of pent-up demand that's sitting on the sidelines that's driving, the potential revenues and earnings of these companies. And so that's going to be the thing that's really interesting here. It's why we only have 75% of our allocation to the bond stock market instead of 100, because there are some really big question marks, but we have more than zero into the stock market, just because there are some interesting scenarios here, some pieces where the economy could be hanging in there pretty well, because we keep surprising to the upside on so many of these areas that the market is, looking at. So very interesting time frame. Going to see probably a bit more volatility because of the conflicting, groups that are out there that are looking at the same data really in polar opposite directions as far as that goes. So we'll see how this plays out, but look forward to being able to talk to you tomorrow. Thank you very much.